If you're kicking ass being a self-employed person and you're thinking to yourself, I'm going to buy me a house, listen to this. Realize that there are so many things you need to understand. By the end of this video, I'm going to be showing you exactly what you need to be aware of so you can save the most amount of money and make that house yours. Please like, comment, but most of all, subscribe. And as a quick thank you to all you entrepreneurs out there, I'm going to show you a picture of me swimming in a ton of gold because that's all of our goals as entrepreneurs. Let's first of all even start talking about why buying a house being self-employed is challenging. Think about this. If you were lending somebody money and one income seemed more stable, the other income seemed like it can be stable, but there's not enough time to analyze it, who would you probably trust more? More likely, the person whose income has been stable in the same way for the last few years. And realize as well that when we went through the crash, there was a pendulum swing of requirements and restrictions that happened to protect the economy from ever being in a situation like that ever again. One of those is the ability to repay, making sure that we scrutinize the debt to income ratio of a borrower so we can ensure that they're not going to be buying a house that is setting up the economy to be on stilts that are going to crack. So when you're looking at self-employed, realize that from the investor standpoint and from a rule standpoint, there's going to be more scrutiny to that from a logic and compliance position. Understanding that, next let's talk about how an investor views the self-employed income. Now, if you have heard you are self-employed and you can't get a loan by a bank,
don't give up.
Doesn't necessarily mean you can't get one. It just means you might not be able to get one with them. There are plenty of programs that might be of assistance to you. Just make sure to do your research. Now, the common program that most try to go get is something called a conventional loan. And in a conventional loan, what is typically going to be required is if you've been self-employed for less than 5 years, they're going to want to look at what your qualifiable income is, and that's defined by how much income you claimed on your taxes. Make sure to clarify this, not how much you claim gross, how much you claimed you made after all your deductions. Uncle Sam, I made 100 grand, but I took this $20,000 deductions on meals and I took this other deduction on expenses. Really, I only made like 40 grand. All the other ones were operating costs for the business. Therefore, I'm not going to be taxed on 100. I'm going to be taxed on 40. And now you have less income that you claimed and less of a tax obligation. Yet we're going to take that 40 grand that you said you made, even though you grossed 100, and we're going to look at the year before as well. And there you said you only made 20. Now we're going to take the 60 and divide it over 24 months to give you a 2-year average so that we can have trust that this is probably what you're going to be able to rely on for the next 30. That, for many of you watching, might be like, holy crap, I did negative the year before. I'm barely going positive. I make money, but on paper, I'm showing a lot less. Well, that's the challenge. So if that's you, what are some things around that? Well, number one, let's confirm if that's truly all the income we can use. There's depreciation that many times we can add back out and different things like that. But what you want to make sure you do is you review your tax plan with a mortgage advisor as well. One of the cool things is that for these type of loans, specifically Freddie, many times if you've been self-employed for more than 5 years or 5 years or more, you can just use a 1-year tax return average instead of a 2-year. That can help you a lot as you plan for the next year's tax round, right? I am not a CPA. I am not giving tax advice, but just want to make sure you're aware of what maybe you need to do some more research on and make sure that you're claiming what's correct so that you can hit your goals.
Always claim what's correct, by the way.
With that being said, let's say that it's not your strategy and your CPA goes, dude, there's no way. These are all expensive. This is blah, 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 right? All that noise they make. What other options you have? Well, there are also investors who have created loans specifically for the underbanked. They know that most business owners are trying to bring their taxable income to the lowest amount possible so that they can pay the least amount of taxes possible. Yet they know that that's what's on paper, not what's in reality. So they have created loan products for the underbanked, meaning those who do this, but the typical rules don't apply, yet they can afford their payment. These are many times fall in the category of what's called the non-QM loan. This type of loan won't analyze your income based on your tax returns. They don't even want to see your tax returns most of the time. They're going to analyze your income based on what your business is producing. So they'll look at personal bank statements, business bank statements, anywhere from 12 to 24 months. They'll take that whole sum of deposits throughout the year and divide it by whatever program you're looking at, 12 months or 24 months. Now, that's your qualifiable income. Just like in the other route, 40-30 over 2 years, that becomes your qualifiable income, and then you analyze how much debt you could be approved for. This is the same thing that's going to happen on the self-employed route. They'll look at your business deposits and see what your qualifiable income is, and then do your debt to income ratio from there. Now, keep in mind, typically over the 12 months, 24 months, then you take 50% of that for most. So let's say your average is 10 grand. Typically, you're going to have 50% of that taken out for business expenses, unless you can find a CPA who can verify that, there's less than that percentage for business expenses. But let's say it's the 50%. Now you have a $5,000 qualifiable income. And from there, if you're doing a 50% down debt to income ratio program, just saying hypothetically, now you can qualify for a $2,500 monthly obligation in debt, including cars, home loans, everything, right? That's a simple example. So now let's say that you don't have those big deposits, or you don't have the bank statements for that.
And blah, 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 blah.
Are there any other options? Yeah, there can be, at least. Another option is there are some investors focused on the underbanked who will do a loan, not stated income. They don't want you to say a fake number. They will do a loan based on no income. Got to have the credit, the down, the property has to be in good shape, but there could be no. And so if you're hearing all this and you're going, well, this all sounds too good to be true, what's the catch? Realize there's no free money, right? And anytime an investor takes a higher risk, they're not doing this for charitable means to go to the underbanked. They're trying to look at making more money and finding an opportunity for it. So you're typically going to see interest rates higher and costs higher in the non-QM loans, especially in that no income loan and so on and so forth. Make sure you understand the key to make you a successful homeowner with the most savings is comparing. With the higher interest rates, am I getting savings in other ways, right? Maybe now your CPA is going, it's not worth paying this tax to do these kind of loans I've heard of. Go verify with the mortgage advisor if that's correct and see what the cost difference is. See what your goals are. There are the different currencies of life. There's cash, right? Or any type of money currency. There's time. There's energy. Make sure you're analyzing all these loan products to help you with those three, and make a good plan that if you do get into this loan and there's some other stuff moving around your business and you have an exit plan for it to refinance into a regular conventional loan in 2 or 3 more years, because your deposits right now are bigger than what your qualifiable income is because of legitimate expenses or something like that. But just trying to say, find somebody smart enough to help you analyze all angles. Make sure you work with a CPA and a mortgage advisor to get all that verified so that you can not just miss out because some bank tells you they can't do it, and in fact someone else can, and the one who loses is you. Let's get you into a home. Let's get you leveraging home ownership. Let's see you be the most successful homeowner you can. Comment any questions, message me for any more specific information. Let us know. We're here to help. See you guys in the comments.